Today, I want to discuss a bit about this title. Trump urges Fed to cut rates as tariff shock shakes President Donald Trump on Friday, Jerome Powell to cut rates, even as his own tariff policy roiled markets and sparked concerns of a renewed rise in inflation, right? So in his statement, Trump said this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. Okay, this was posted on his social media, the Truth social media. And he added one thing. He said he is always late, but he could now change his image and quickly. Energy prices are down, interest rates are down, inflation is down, even eggs are down 69%, and jobs are up, all within 2 months. A big win for America. Cut interest rates, Jerome, and stop playing politics. Now, we all know that Trump is a big fan of capital letters, and I'm just um, copying exactly, what he wrote on his social media. So at the same time, market expectations for rate cuts have shifted dramatically. Okay, I like to monitor before and after, and here is the result so far. Now inside here, this is showing that the no rate cut stays at the 66.7%, whereas a rate cut for the May 7 FOMC meeting right now, the interest rate to be reduced by 25 basis points is at a 33.3% probability. Now, what I want to highlight right over here is this, right? A week ago, the CME FedWatch Tool showed only an 18.5% probability of a 25 basis point rate cut in May. That probability has since surged back to over 30%, the level seen a month prior. The month before we had a 37, but it's slowly crept down to 18.5, only to see going back to 33.3%. However, the biggest shift is not the May one, but it's in June. The market is now pricing in a 94.5% chance of a rate cut, with additional cuts likely in July, September, and December. Now, this is what is projected by the market, not by the Fed. Yeah. So this marks a sharp turnaround before the tariff announcements. Market expected the first cut only in July. Now we are seeing that the first cut probably would be in June, 1 month earlier, right? So tariff change the game. Trump's newly announced tariff unveiled on last Wednesday, have heightened fears of a global economic slowdown and triggered volatility across asset classes. The potential for higher consumer prices and reduced global trade has left investors reassessing the path of US monetary policy. Now, Fed Jerome Powell, speaking the same day in Arlington, Virginia, acknowledged the uncertainty. The new tariffs are likely to raise inflation and lower growth, state Powell, noting that the Fed would need more clarity before adjusting interest rates. Now, while he described the US economy as currently strong, he emphasized the risks posed by tariffs and reaffirmed the Fed's focus on containing inflation, suggesting that interest rates cut may not come as quickly as or as deeply as markets are anticipating. So what we have over here, we have the market saying that, hey, we are going to see probably 4 rate cuts because of this tariffs is going to bring a lot of stress to the market. But again, what we have on the other hand is the Fed saying that, we are seeing that the tariffs is going to raise inflation and lower growth. So probably we need to be very careful and not, jump the gun and start reducing rates until we see, inflation coming down. So this is what I call a clear divergence, where the market is saying one thing and the Fed is saying another thing, right? Because it's a growing divergence between the Fed's cautious stance and market expectations, as seen in the CME FedWatch Tool. While the Fed emphasizes the need for data-driven patience, markets are increasingly betting on a series of cuts to offset the potential economic damage from tariffs. Now, think of it like this: market price hold central bank manages risk, right? So the Fed Watch Tool does not predict policy decisions better than the Fed. Instead, it reflects what traders believe the Fed will do based on the latest data. Okay. Now, why I say this? Because there is the last 2 years, whenever if you've been following my report, you would have noticed that whenever I said there's a 70% chance that we see this probability happening, then most of the time it will happen, right? So basically, this Fed Watch tool here is a dynamic, sorry, what I call a dynamic real-time barometer of market sentiment, adjusting rapidly to new inflation figures, employment reports, and geopolitical developments. Okay, so who's right, the Fed or the market? I think that's the million-dollar question, right? Now, the answer depends on how incoming data unfolds, especially on inflation and employment. So basically, if inflation remains sticky, especially due to tariffs, housing, or services, the Fed will prevail, keeping rates higher for longer. Now, if inflation cools faster than expected, the growth slows meaningfully, the market view will be validated and Powell may pivot to cutting. So this, I think he can keep it simple because everything is based on facts, right? Has it happened before? So I dug into it, and here's some historical, things that happened in the past, and we can use that as a reference. Now, historically, both sides have had their moments. Now, in 2019, market pricing rate cuts early. The Fed resisted at first, citing a strong economy like now. So by July, faced with a trade war headwinds, the Fed began cutting. And in this instance, market were right first and the Fed followed. In 2023, markets expected cuts after banking stress. If you remember, the regional banks, like the SVB collapsed in the US. So the Fed held firm as inflation remained elevated. So in this point of time, the Fed was right, market had to reprice. Now, the situation, what we're facing, um, seems to be following the 2019 path. So there is this possibility that we may be seeing that uh, the market may be pointing to the direction that the rate cuts is evident, and there may be more rate cuts than before. Okay, because this was due to the trade war, and we are having a trade war right now, right? But anyway, let's see. So at the end of the day, what's the outlook? It's basically a game of data. Now, as of April 20, still above the 2% target, and new tariff injects fresh uncertainty. However, if upcoming CPI and core PCE reports show sustained softening, the Fed may be compelled to align with the market's expectations. Until then, the tug of war continues between Wall Street's anticipation of easier policy and the Fed's need to maintain credibility and price stability. Okay, so this is something that I think we need to understand, um, and we will see. Okay, from there, one step at a time. I think the next week, I think, would be crucial because we would see replies from various nations. Most of them I've seen so far, they choose to just say that, it's not nice to do this, but we won't be retaliating so far. The one that has retaliated is China, and this could be followed by Europe, mainly the Germany and France. But, we shall see if things if it hits up, yeah, we could see more downwards move in the market. Else, I think recovery it's very, very possible. Okay, so with that, that's the fundamental report for today.